Welcome back to this tutorial on financial modeling on Android using Kaluta projection methodology. Last time we ended up juxtaposing cash flow from operations derived from this methodology and the cash flow from operations derived from using indirect cash flow method. This methodology uses actual cash flow method. Now let us go to the part of business modeling where we do it in our projected annual cash flow. So I am in projected annual cash flow sheet here, and here is where we are going to do our tutorial. So I double tap here to type business valuation. Okay, here is where I will do my business valuation. Let me bold this. Okay, so to do business valuation, we need to compute the cash flow that will be used for that purpose. And this is the cash flow or the residue cash flow after deducting all cash flow from operations, all needs for working capital requirements in the cash flow from operations here, and deducting cash flow from investing activities. Okay, that is funding for fixed assets. Okay, so after removing these two elements, you are remaining with the cash flow that is available for providers of capital within the business, and these are the ones that are presented here in the cash flow from financing activities, where we have capital and loan. So the providers of capital and loan, the cash that remains after deducting cash flow from operation needs, those are working capital requirements needs, and cash flow from investing needs. So the cash flow that remains after that is called unlevered free cash flow. So we are going to compute our unlevered free cash flow for the purpose of valuation. Okay, so we start with cash flow from operations. So I start with equal sign and go to pick the figure here, cash flow from operations in year 0. Let us concentrate on year 0 only, because these are the formulas. We will simply drag them to the rest of the years. So that is cash flow from operations. But this cash flow from operations has already deducted loan interest, and this component is the payment for providers of capital, that is loan owners. Okay, so we need to add this back to arrive at the cash flow that is gross of payments to providers of capital within the business. So we add it back, interest component, so to add it back, I start with equal sign and then start with negative sign and then pick the figure for interest, because here it is presented as a negative number because it draws out cash. So I started with negative sign to turn it into positive. Okay. So after that, we are now going to other adjustments is to add back this tax figure here, because in order to compute tax you need to deduct loan interest among other things to arrive at profit before tax figure and from that figure you compute tax, accounting tax. Now, because we want to take away with the effects of any cash flow effects that relates to providers of capital, we'll need to add this tax back into our cash flow and recompute a tax figure that is computed before deducting interest payment. Okay, so we will add back here accounting tax. Accounting tax figure. So we start with equal sign and negative sign, and then pick the tax figure here in year 0. And after adding back accounting tax, we will now need to remove the theoretical tax. This is the tax figure computed after adding back interest payments to arrive at profit before tax. And then we will compute it. And then we will need to remove from cash flow from operations cash flow from investing activities, CFIA. So I add back here start with equal sign and start with negative sign and pick total figure for cash flow from investing activities in year 0 here. Press enter. Okay, and the sum of all these will now be our, so let me put a sum here and press enter. So this one will give us our cash flow unlevered free cash flow, aka free cash flow to the firm. So we are missing here is computation of theoretical tax. So we go to our annual P&L sheet here to compute it. So we start with profit before tax. Let us concentrate on year 0 again, which is this figure. And then we add back interest component. So start with equal sign and then pick the interest figure, which is here in finance expenses. This is total finance costs, so that is interest component. So we add it there, and after adding it, that is the only expense item that is related to financing. So we will have our adjusted profit before tax, which is the summation of those two components. And from this now is where we will compute our theoretical tax. From the adjusted figure. Okay, now let us first select these, because there are formulas here. I fill to the rest. So for year 0, because we have net adjusted gross loss, loss before tax, there is no tax component. In year 1, for the adjusted figure, we need first to deduct the cumulative loss before we compute the tax figure on this adjusted tax figure of 131 million. So the formula for year 1 will be, we start with equal sign and then open bracket, take this figure plus this one, close the bracket, and then multiply by 30%. Press enter. So that is the tax component for year 1. For year 2, because we do not have cumulative losses, so we take tax computation directly from our adjusted tax figure, which is here. So what we do is simply start with equal sign and then click on this adjusted figure and then multiply by 30%. So that is our tax figure for year 2, and this one is going to be true for year 3 also. So I tap to fill this to year 3. So we have our theoretical tax figures. These are the tax computed on profit before tax, which is gross of interest payments. Okay. Now we go to our annual cash flow sheet, and now we plug this theoretical tax. We added back accounting tax, now we deduct the theoretical tax. So starts with equal sign and then start with minus, and then click on annual profit and loss sheet and pick on the figure for tax here in year 0, press enter. So we have all these formulas here for arriving at our unlevered free cash flow. So I just select all of these and then fill to drag them throughout our projected horizon. Okay, so let me also format this. All this here should be, click here on 1, 2, 3, put, and then click again on 1, 2, 3 sign, time sign here, and then remove decimal places by clicking here twice, and then choose number, negative numbers to be red. Okay, so just arrangement. So we have our unlevered free cash flow. As I said, this cash flow is available for distribution to providers of capital, that is debt owners and equity owners. Debt owners in form of interest payment and loan repayments, and equity owners in terms of dividends or withdrawal, if any. Okay, so we computed this figure. Why we use this figure? Because this figure first allows for comparison between one business and another, because it has taken out the effect of the capital structure in, or the effect of leveraging in business. The cash flow that is used for valuation is available for distribution to both providers of capital within the business, debt holders and equity holders. So it is comparable, and that's why it makes sense to use unlevered free cash flow. And this cash flow, as I said, it's taken from cash flow from operations. You add back interest component, you add back accounting tax, and then deduct theoretical tax, and then cash flow from investing activities. Okay, here. Okay, I started with negative numbers. It's not okay. It should be with positive number because we remove the investing activity component, so we should not start with negative here, and instead it should be positive. Okay, and this one, let me tap to fill this throughout, because these financing activities draws out cash from the business, and we need to remove them to arrive at unlevered free cash flow. Okay, so from our unlevered free cash flow, and as I said, we started with cash flow from operations. Our cash flow from operation using this method, which is this one, actual cash flow method, does not have any adjustment for non-cash items, because in this actual cash method we only deal with cash items. So adjustments for non-cash items are not accounted here in total cash from operations. And also, this total cash flow from operation has already accounted the working capital requirements. Okay, you saw that when we compare our cash flow from operations and our indirect cash flow method. If you haven't checked that tutorial, go back and check it. It's the tutorial previous to this one. So already working capital effects has already been taken into consideration or taken on board before arriving our total cash flow from operations. So the only cash flow item we need to deduct is cash flow from investing activities, which is deducted here, right? Of course, in this presentation, cash flow from our financing activities, loan repayments are here in the cash flow from financing activities part. Okay, so our cash flow from operations does not have the effects of loan repayments. That's why this is unlevered free cash flow, because it does not take into account the loan interest. We have taken interest back, and loan repayment is not in the cash flow from operation. It's another section which is not here. So loan repayments have also not be netted from this unlevered free cash flow from operations. Okay, and so if you were interested in computing for levered free cash flow, okay, then what is missing from this, for example, just a matter of, if you want to get levered free cash flow. Okay, so if we will start with our unlevered free cash flow here, figure, okay, then we will have to remove interest component. Okay, so interest component equal to, so we will have to remove this component here, interest, and we will have to remove loan repayments. Loan repayments. Loan repayments here, we get them, start with equal sign and then pick them from here, loan repayments. Okay, so there is where there are loan repayments, and the sum of this now will be our levered free cash flow. Let me select this and fill to the rest of our projected horizon. So basically, levered free cash flow is also aka free cash flow to equity holders. Okay, so this is the cash flow that has already deducted the cash flow related to providers of loan within the business. Okay, so it is called levered free cash flow, or free cash flow available to, or free cash flow to equity. Okay, so this one is not used for valuation purpose, levered free cash flow, because capital structure is discretionary, so it will not be comparable between one company and another when you use this one. Okay, so that's the main reason for using the unlevered free cash flow component on top there. Okay, so we don't need this one, this component here. Okay, for our planning purpose, for our computation of valuation for this business, we don't need this levered free cash flow component, so we will hide this. So for this presentation, let us end up here. Welcome back to my next tutorial that will now do the number crunching for business valuation, that is computation of net present value, internal rate of return, payback periods, terminal value. Okay, so those ones will come in the next tutorial. Subscribe to my channel so that you get posted whenever I share new content relating to financial modeling using Kaluta projection methodology. Thanks for listening. See you. Bye.